Are liquidity pools taxed in the US? Welcome to Crypto Tax Made Simple, brought to you by Crypto Tax Calculator. I'm Chris, and I'm here to simplify crypto taxes in the US so you can file with confidence this tax season. In this series, we're breaking down the basics like capital gains and income tax, as well as more complex activities like staking, DeFi, and NFTs. Our goal is to help you so you can hang on to more of your gains while staying on the right side of Uncle Sam. If you are deep down the rabbit hole and have provided liquidity to DeFi protocols, this video is for you. While there is a lack of specific guidance surrounding the tax implications of nuanced DeFi activities like liquidity pools, this isn't an excuse not to report your DeFi activity. There is enough guidance to infer how the IRS may view many situations. When determining the tax treatment for activities that fall into a gray area, it's important to consider how your involvement could be treated from a tax perspective. The tax implications can hinge on the specifics of your engagement with the protocol. Let's examine a scenario, as well as the possible tax treatment to understand this better. Imagine you spend $2,000 to acquire some ETH and some stablecoins. At some point in the future, you decide to deposit them into a liquidity pool. At the time you deposited them, their combined value had risen to $2,500. The conservative tax treatment would be to treat this deposit as taxable. The gain will be calculated by taking the cost basis of the assets you disposed of, $2,000, and subtract it from their market value at the time of depositing them, $2,500. This gives you a gain of $500. The more aggressive tax treatment would be to treat this deposit as non-taxable. Be aware that more aggressive treatments could expose you to underreporting and may lead to an increased chance of an audit. In the case of the more aggressive treatment, the economic intent of the transaction would also come into question. For example, if the intent was to earn rewards, not dispose of the assets. Having detailed records to support your claims of economic intent are essential in case of a future audit. The specifics of the protocol and your interaction with it may also come into question. Some protocols provide LP or receipt tokens in return for liquidity deposits. As we know, trading between cryptocurrencies is treated as taxable by the IRS, which may mean deposits that receive a LP or receipt token in return could be viewed similar to a swap and thus be taxable as well. In this case, when you decide to withdraw from your pool using your LP or receipt token, another significant tax consideration arises. The disposal of the LP token might lead to another capital gain or loss. Taking the original scenario as an example, let's say you received an LP or receipt token when you deposited into the liquidity pool. The token's original acquisition value was $2,500, the market value of your ETH and stablecoins at the time you deposited. If the value of the assets you get back is less, say $2,300, you've incurred a capital loss of $200. On top of this, you must also consider any token rewards or interest earned on your liquidity. The IRS considers the market value of the tokens at the time they are received as income. And when you eventually sell them, the disposal will also trigger a capital gains tax event. For example, if you earned $100 worth of token rewards from your liquidity deposit and later sold the reward tokens for $150, you would need to report both $100 worth of income plus the capital gain of $50. As you can see, providing liquidity can become extremely complex for tax purposes. Crypto Tax Calculator has been built from the ground up to support complex on-chain activity, such as liquidity pools, and is a lifesaver if you have fallen down the rabbit hole of DeFi. Seamlessly import your transactions. Watch our smart tax engine automatically label them and then generate your CPA-approved crypto tax report, which you can file directly with TurboTax or share with your tax preparer. This concludes our series, Crypto Tax Made Simple. To avoid a crypto tax nightmare and file with confidence this tax season, click on the link in the description to get your crypto tax report. Thanks for joining us, and stay tuned for more educational content in the future.